Hello, and thank you for joining me, Fiona Cincotta, Senior Market Analyst here at City Index, as we look ahead to next week. Starting the 26th of February, we'll be looking at the main macro events, and then also the markets, which these relate to, and perhaps strategies, how to be trading them. So before we get started, I do just need to ask you to read this risk warning. Just take a few moments. I'm just going to put myself on mute whilst you do that. Okay, brilliant. So as we do, we'll just first of all take a look at the economic calendar. So just bear with me one moment whilst I pull this up. So this is the economic calendar on the City Index website. As always, I've just filtered it by high importance and for items for next week. So just working through the list, let's just kick off. So over in Australia, as we start, so on Monday and Tuesday, so there are no major high impacting events to be watching out for. Things don't really start to kick off until Wednesday, when we've got monthly consumer price expectations for Australia. They're expected to tick higher from 3.4% to 3.5%. I think it's quite interesting to know what's going on as far as the RBA is concerned. So if we just remember back to the RBA meeting earlier this month, and basically the RBA decided to keep its interest rates on hold at 4.35%, so nothing alarming there. But interestingly, in the statement, the rate setters indicated that the next move they make could be up or down as far as interest rates are concerned. And I think that's basically interesting. What they said is that a further increase in interest rates cannot be ruled out. So, you know, although inflation has been trending lower, we do seem to be getting to this point where it's getting a little bit sticky and they're struggling to pull it lower, which does mean that there is a potential that interest rates could increase. Now, what we're just going to do is have a quick look here at what's been going on for the Aussie dollar. We're just going to pull up the chart here. Aussie dollar, US dollar. It's been really interesting. We've seen that the Aussie dollar has managed to pick up from the low here in February last week of 0.6440. It's pushed higher, extending those gains. Now it's just struggling here. This is really quite an important level around the 65.70. 65.60. We've got the 200 SMA. You've also got this falling trend line, which goes back right to the start of 2023. So here we've got the confluence of that 200 SMA along with that falling trend line. And as we can see, the price has really struggled to push higher there. We've got a couple of longer upper wicks, which suggest that demand at those higher levels hasn't been strong. And I mean, this is what we're going to be watching for. If bulls can actually get a close above that level of around the 0.6570, and also perhaps take out this the weekly high at 65.90, then that's going to be a really encouraging sign. But if we do see a rejection here, then there is a chance that we could see a retest of the 65.25 level, and then also the 65 round figure. So that's going to be what really key area to be watching out for, how that closes. Right, just going back to the economic calendar, we've got the Reserve Bank of New Zealand. They've got their interest rate decision. No change is expected. Again, it'd be interesting to watch out for the wording on that to see whether they are also going to be suggesting that interest rates could go either way, that interest rates could equally be raised or lowered in the next move. And then ticking on, we've got GDP for the US. This is the fourth quarter, expected to see 3.3% growth annually. I mean, we know that the US economy has been having really quite a resilience, been showing really relative strength, given that interest rates are at a 22-23 year high. We've seen that the economic growth has remained resilient, even in the PMIs that we saw come through yesterday. We saw that they remained above the 50 level. Growth is slowing slightly, but nothing too alarmingly. We also saw those jobless claims yesterday that came in stronger than expected. So, I think GDP data will be in focus. It's signs of ongoing strength in the US economy. It's going to be something that could boost the US dollar. US dollars have a little bit of a funny run recently. It's actually expected to trade lower this week against its major peers, and that's despite the minutes from the Federal Reserve meeting reiterating that sort of slightly hawkish tone, that interest rates aren't going to be, or there's no rush to start cutting interest rates. And also, as I said, the stronger than expected jobless claims data also supports that view that there's no rush to start cutting rates. But even so, that seems to be priced in at the moment. This isn't a new message now. We've been hearing this for some time from the Federal Reserve. That's what sort of sparked that rally up that we can see here, and that strength in the US dollar. But, until we get sort of now fresh catalysts, which will probably come from core PCE, next week, the dollar has just sort of struggled to make fresh highs. And we can see here, this is the Japanese yen. Also, the problem we've got with the Japanese yen, with the yen also now in recession. Data from Japan has been relatively weak. The PMI manufacturing was weaker than expected. So, there doesn't seem to be any major reasons for, or data really shouting to the Bank of Japan that they need to start hiking interest rates. So, and that's what we've seen here with this run up in the US dollar Japanese yen. We've seen the market sort of reining in Fed rate cut bets, and at the same time they've been reining in Bank of Japan rate hike bets, and that's pushed the pair up to that 150 level, which makes it vulnerable as well to FX intervention here as well. Now, just having a look at the chart, this level here, 150.90, that was last week's high. That's going to be the level that it needs to take out in order to charge higher towards the 151.90 level, which is a multi-decade high. If we do see failure to push above this level, a rejection on the downside, support here around the 148.80 level. That's the sort of mid-January high, and beyond that you've got the 100 SMA at 147.80. So let's continue. What else we got? So we're already on to Thursday. So we've got retail sales from Australia. As I said, look, they're expected to come in slightly stronger than in December, so looking for a rebound. That would support the view that we've been saying about sort of, you know, potentially inflation sort of being sticky, pushing higher, potentially the RBA keeping interest rates on hold, and if not, potentially moving them higher, or at least not taking a rate hike off the table. Then moving on to German data. Now we've got retail sales. They fell quite sharply in January. Germany's economy has remained under the spotlight this week as well. We've seen the IFO business climate did pretty much stay where it was. We saw GDP data confirmed a 0.3% contraction in the German economy, and the PMI data really highlighted that massive drop-off in manufacturing. The PMI fell to, I think it was around 42.2, down from 45.2. So, you know, really big fall in PMIs. And that's basically amid sort of a real drop-off in demand, both domestically and internationally. As well as the retail sales, we've also got German inflation data, which is expected to show that inflation cools further in February to 2.8%. That'll be some good news for the ECB, as the Eurozone's largest economy sees the inflation level move closer to the target rate. So let's just have a look at what is going on in the DAX. Here we've got the DAX. I mean, look at this, trading at record highs. This basically rose to a really impressive rally yesterday, but we saw that globally after the NVIDIA results came out, sort of really supporting the AI story that has helped sort of stocks rally across the end of last year and beginning of this year, as well as the idea that the next move by the ECB is going to be a rate cut, which is also supporting demand for equities. Buyers are going to be looking for a rise over 17,500 in order to extend those gains. As I said, these is fresh all-time high, so it's fairly uncharted territory above where we are. As far as support is concerned, 17,000, that's this level here, the line here, that's the February high, late January high. That's going to be an area of support to be watching. So moving on, what else have we got? US core PCE. So this is the Fed's preferred gauge for inflation. On a annual basis, it's expected to fall to 2.8%. On a monthly basis, it's expected to rise from 0.2% to 0.4%. I mean, if we just have a look here, we can see what's been going on. Let me just make this a little bit bigger for you. What's been going on as far as core PCE, the Fed's preferred gauge for inflation, is concerned. As you can see on the left-hand side, you've got the month-on-month personal consumption expenditure data, and then you've got the year-on-year on the left-hand side. As you can see, you know, that chart, particularly the one on the left-hand side that we were looking at, the year-on-year, there is a steady decrease in core PCE. I think that's quite clear. What we're seeing though, and what we're hearing from the Federal Reserve, is that they are in no rush to start cutting interest rates. They're cautious. They want to make sure, they want more data to confirm that rates are falling towards the 2% target before they start to cut. So despite sort of there being signs that inflation is on the right path, we're still seeing a level of caution in the Federal Reserve. And that's basically the other thing to watch out with these figures, is the personal spending. Personal spending has been really quite strong in this data set in recent months. And I think that's just something that the Fed will also be keeping an eye on. Obviously, increased personal spending is inflationary, and so that's the reason that the Fed will be watching that. So let's just have a look at some charts. I think gold perhaps is always a good one to be watching as far as inflation is concerned. Here we go. So we can see gold is, I mean, it's trading pretty much core above around that 2025 level. It's rebounded off the 100 SMA, pushing higher, but you know, it's really struggling here around that multi-month rising trend line resistance, not being able to push above that at around the 2035 level. You know, we're seeing the flat RSI, so not many clues as far as that's concerned. Buyers are going to need to take out that level at around 2035 in order to extend towards the 2050 and also then the 2065, which is the February high. On the downside, if we sort of continue to face rejection at that rising trend line resistance, then perhaps the nearest supports down there at the 2000 level, which is also the confluence with the 100 SMA. So it could prove to be a tough nut to crack. And let's have a look now at the S&P 500. It's been rising in this ascending channel since the beginning of November. It's been surging. It's trading at a fresh all-time high. 5100 it seems to be the level to be. If we can get above that, then that means we'd potentially be looking for a rise to around the 52.25 level. That's the upper band of the rising channel. On the downside, I mean, as far as support is concerned, there isn't a huge amount to be watching here. Maybe around the 49.30 level. That's the mid-February low. That could offer support in the near term, and a move below that would actually negate the near-term uptrend. That brings this level here, which is 49.50, into focus, and a breakdown there would bring a fresh low, would create a new lower low. Whilst we're here, just also going to have a look at the Nasdaq. So this is the Nasdaq again, seeing it just trying to top over those the fresh all-time high there. Be looking for a rise above 17,990. That's the level to beat as it heads towards 18,000. Again, this is going to be a fresh all-time high, so you know there's not much to go on beyond that. As far as support is concerned, then this level here, which is 17,650, that could offer some support, and a break below that would create a lower low. So going back to the calendar, where are we? We've also got a bit of Canadian GDP. Here we go, some China data. We've been watching China relatively closely as the recovery post-COVID has really failed to take off. I think would be the best way to describe it. And then obviously we've got these ongoing problems in the property sector. There are some support measures which are being brought in by Chinese authorities and the People's Bank of China in order to stimulate growth, particularly in the property sector. So, you know, the manufacturing here in January, the activity had just remained over the 50 level, suggesting growth. One of the markets that's good to be watching as far as China is concerned, basically because it has such a high number of resource stocks, is the FTSE 100, but just wait till I get there. Here we go. So the FTSE, you know, it's trading above this rising trend line. It's failed to push much higher above 77.40, and we see that it's just pulling lower as we speak. However, I mean, it still remains towards the upper end of this trading range at that 77.65 level. So if we can get sort of buyers to beat 77.65, then above that we've got this high here, which is the I think it's the mid-May. Just bear with me whilst I double check. Yeah, so this level here, sorry, 7,800, which is the mid-May last year highs, and also the round number. On the downside, finding a little bit of support here on the 50 SMA, which is around 76.32. Key support level really is going to be the 200 SMA at 75.50. A break below there would suggest that the buyers are actually in control of the price movement. And then let's see. Finally, we've got the Eurozone inflation. So Eurozone inflation is also expected to tick lower to 2.5%, down from 2.8%. Now, let me just pull up, just bear with me, this one here. Here we go. This can show how it had been trending really quite nicely lower until a couple of months ago, where it caused 2.4%, and then from there it actually ticked higher to 2.9, 2.8 in January. It is expected to be back down towards that 2.4% in February. So really signs there that the Eurozone inflation is cooling. Yet interestingly, the minutes this week from the latest ECB meeting shows that they are still reluctant to talk about cutting interest rates. So although the inflation is almost back at the Eurozone's 2% target level, they still are not prepared to be talking about interest rates. Interest rate cuts, which I find quite interesting, given that with inflation so low, they could in fact be one of the first major central banks to start cutting interest rates. Now, with that in mind, the euro has struggled to make moves. So let me just get up here, euro, US dollar. Here we go, we have a look at the chart here. This is a really interesting chart. You see that it's been trading in this falling channel. It's rebounded off that 107 level, but really struggling at the 200 SMA here. We did have a spike higher yesterday. That was following the PMI data, but it was short-lived. But we're really struggling to get a close over the 200 SMA. That's what the market's going to be looking for. That's around the 108.30 level. If we can get a close above there, that does mean that we could be looking then for a move towards that 109 level. But failure again, if we get ongoing rejection at this level, could see the pair drop back into that falling channel and look to support at 107.25 and then 107, which is the February low. Excellent. So thank you so much for joining me here, and it's been a pleasure to have you. If you do have any questions, then please do pop them in the box or contact me on Fiona on Twitter at Fiona City Index. And otherwise, I will look forward to seeing you same time next week.